Ladies and gentlemen, good day and welcome to Hindware Home Innovation Limited Q2 FY24 earnings conference call hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Udit Gajiwala from Yes Securities. Thank you and over to you, sir.
Thank you, Yusuf. Good afternoon and welcome everyone. On behalf of Yes Securities Limited, we invite you to Q2 FY24 earnings conference call of Hindware Home Innovations Limited. From the management side, we have Mr. Sudhanshu Pokhriyal, CEO of Bath Business, Mr. Rajesh Pajnu, CEO of Pipe Business, Mr. Salil Kapoor, CEO Hindware Home Innovations Limited, Mr. Sandeep Sikka, the Group CFO, and Mr. Naveen Malik, CFO of Hindware Home Innovations Limited. I would like to hand over the call to the management for their opening remarks, post which we'll open for a question and answer session. Thank you and over to you, sir.
Thanks, Udit. Good evening, ladies and gentlemen, and welcome to Hindware Home Innovation Limited Q2 and H1 FY24 earnings call. I would like to provide a brief overview of our company's performance for the quarter, post which the business CEOs will share the key highlights of the respective businesses. Our performance during the last quarter is in the background of challenging macroeconomic conditions leading to slowdown in urban and rural consumption. Our company delivered a revenue of rupees 700 crore in Q2 and recorded EBITDA of rupees 80 crore. In H1 FY24, our revenue was 1,334 crore and EBITDA stood at rupees 148 crore. Looking ahead, our primary focus in the short term is to build a pipeline of innovative, smart and interconnected products that seamlessly blend innovation and aesthetics to enhance the quality of life and living spaces for our valued customers. Despite the challenges presented by the current economic landscape, our commitment to growth, innovation and customer centricity remains unwavering. We remain confident about the prospects of our businesses and its ability to drive growth. I would like to call Mr. Sudhanshu Pokhriyal to take you through the bath business. Over to you, Sudhanshu.
Thank you, Naveen. Good evening, everyone. During the review period of Q2 of FY24, we delivered a YOY revenue growth of 5% in Q2 and 2% in H1. This growth was achieved despite inflation challenges, higher interest rates and liquidity pressure. This resulted in relatively soft demand from mid and lower price basket products. Our profitability and margin performance has been strong in the quarter under review. Our EBITDA expanded 33% year-on-year to rupees 16 crore, translating to an EBITDA margin of 16.1%. Our consistent emphasis on improving our product mix and efficiencies is reflected in this performance. As we look ahead, our focus continues to remain on expanding our presence in new markets while maintaining a strong emphasis on productivity enhancements and working capital management. Capital investment will be directed towards establishing brand stores for market expansion and enhancing manufacturing efficiency. These strategic efforts are aimed towards elevating our product pricing and enhancing our margins. Our diverse marketing investments play a pivotal role in helping us connect with our customers across the country. Our integrated marketing initiatives, including the dynamic IPL, Asia Cup, and the current ongoing Cricket World Cup campaign, is helping us enhance our brand visibility and appeal. Additionally, our partnership with Water Management and Plumbing Skill Council, called WMPSC, underscores a commitment to upskilling 5,000 plumbers over the next 2 years, reinforcing our dedication to skill development and industry advancement. We are confident that we will maintain and enhance our market share by pursuing our growth strategy. This strategy includes launching innovative products, strengthening of the Hindware brand, expanding our distribution to tier 3 and 4 cities, and enhancing our luxury brand Keo. These efforts are supported by a robust influencer program for key stakeholders and comprehensive marketing campaigns for all our brands. Additionally, a strategy to bring large-scale production in-house aligns with our overall objective to improve value creation. In conclusion, our strategic initiatives reflect a commitment to growth, innovation, and delivering exceptional value to our customers. I would like to now hand over the call to Rajesh Pachnu to take you through plastic pipes and fittings business. Over to you, Rajesh.
Thank you so much, Sudhanshu. Good evening, everyone, and thank you for joining us for our Q2 and H1 FY24 earnings call. TrueFlow, our established brand now for plastics, pipes and fittings, maintains its position as one of the fastest growing brands in the industry in our addressable segment. In the review period, revenue stood at rupees 201 crore in Q2 FY24 and rupees 357 crores in H1 FY24. The revenue was primarily affected by a sluggish demand environment in the home plumbing segment, combined with volatile raw material prices in a quarter that was driven by the agricultural pipe space, which is not our target market. Our EBITDA stood at rupees 22 crores in Q2 with a double-digit margin at 10.8% and rupees 32 crore in H1 with margin at 9%. Despite some headwinds, we endeavored to maintain prices while actively enhancing brand awareness to expand market share and presence. Further, we have been proactive in engaging with plumbing consultants, plumbers, and have organized various training sessions for our channel partners and influencers. These efforts will continue in the upcoming quarters to enforce our market presence. Our dedication to expanding our distribution network also remains unwavering, with over 300 active distributors and approximately 30,000 retailers currently in our network. We are in the process of establishing a new state-of-the-art manufacturing plant in Roorkee, Uttarakhand, and construction of the facility has already started. The plant is expected to be operational in Q3 of FY24-25. To conclude, TrueFlow remains committed to achieve its goals of market expansion, enhanced brand awareness, and profitable growth. I would now like to hand over the call to Mr. Salil Kapoor to take you through consumer appliances and retail business. Over to you, Salil.
Thank you, Rajesh. Good evening, everyone, and thank you for joining us for our Q2 and H1 FY24 earnings calls. In Q2, our revenue stood at about 96 crores, and in H1 it came in at about 202 crores. The market sentiment faced its fair share of challenges, primarily due to muted slow consumer demand, and which happened more in the smaller towns and the rural areas. We, however, use this time to focus on some of the basic hygiene factors like working capital, and have improved our inventory levels and our working capital on that front. However, over the coming quarters, the market has a positive outlook on the back of the upcoming festival season and increased demand from e-commerce. In our kitchen appliances business, we continue to retain our leading position, even in the midst of our market grappling with inflation and intensified competition. However, our cooler demand did come down. It was badly impacted due to unseasonal rains, especially in Q1, and some of it also continued to Q2. That concludes the opening remarks, and I would like to ask the moderator to open the floor for questions and answer sessions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Participants must restrict their questions to only two, so that other participants are also getting a chance to ask a question. First question is from the line of Akshay Chheda from Canara Robeco Mutual Fund. Please go ahead.
Yeah, so thank you for the opportunity. So one question, so this is on the piping side. So sir, if you see the EBITDA per kg, that is around 21 rupees, or even if I see the absolute margin of around 10.8, so I mean, this is on the higher side. So will it sustain going forward, or was there any one-off, or how do you see this margin? So that was the first question.
Yeah, EBITDA per kg is a mix of, basically it is the product mix what you are selling in the market. So whatever we have maintained now, we see this going forward, we can maintain it, but it depends on the prices of PVC which have come down heavily. There needs to be a correction in this PVC price, which is expected. Maybe we are hopeful about it after Deepavali. The EBITDA per kg will be basically we have to see it from an angle of realization per kg, sir. Because EBITDA per kg is something which is your total EBITDA, whatever you have achieved by having that product mix volume.
So sir, how do you work, sir? Do you work on the percentage margin or EBITDA per kg, sir?
Percentage margin.
Okay. Sir, I understand that your capacity will come up only after 1 year. So, and currently I think you are running at optimal capacity utilization. So, wouldn't you be out of capacity?
See, we have already started the construction in the next financial year Q3. We are expecting that we will be commencing our commercial production. Till that time, we are trying to maintain with the capacity, and we are also enhancing the capacities in our existing capacity plant, which is at Hyderabad. We are only working with one location at the moment, with 2 plants here at Hyderabad.
Okay. So, but then can you go to 12,000, 15,000, or this is the maximum you can do? Because I think that you might be capacity constrained going forward, sir.
Sir, what 15,000? Can you repeat, sir?
No, sir. I was asking, sir, you are at around 10,000 over 12,000 of a quarterly capacity. So, what maximum you can go up to? Saleable capacity is what I'm asking, because at current rate, I think your capacity constraint.
Presently, we have a capacity of 52,000 metric tons, and we are running at a capacity of around 85% capacity utilization, which is highest in the industry.
Exactly. So I was worried that wouldn't we be capacity constrained going forward? So that was the question.
No, we are adding up we have the facility to add up more capacities in the existing plant, sir.
Okay.
We are doing that.
Okay, sir. Thank you, sir. That's it from my side.
Thank you. Before we move to the next question, a reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Jagir Nasir from Nasir Investments. Please go ahead.
Sir, good afternoon, and I think it's a decent set of numbers. Sir, our focus on pipes and fittings, I mean, we've been talking of pipes and fittings being the growth driver, but don't you think that pipes and fittings has become more of a commodity kind of a business with a level market and lot of players? So shouldn't you think that we should be focusing more on our bathware and building products division and our new introduction of geysers and consumer products? Your thoughts and your views on how the top line will increase, irrespective of what happens in the pipes, plastic pipes and fittings, sir. That can be a segment, but that has become too much of a focus, sir. Thank you.
This from the perspective of overcrowding of the market. You see markets in India are getting competitive from all angles. It's not that the bathware product market is not competitive. So when the markets are getting competitive in a limited span, let's say sanitary ware market, it's let's say 5,500-6,000 crore market, or a faucet is 12,000 crore market. Each and every company has to find a way so that, it can use its brand to expand the horizon in terms of, very nearly related product categories. So like we were front of the wall, now we've gone behind the wall. We have been very successful. So markets will always remain competitive. It's how you open the market. I think if you see the success of our pipes division, it's a 5-year-old business which we started in August 2018 after the setting of the plant. We are doing, like last quarter we done 200 crores. Last year we done almost 790 crores of turnover, which is a fairly successful business in terms of development of the market. The market has accepted the product. Market distributors have accepted the product. Product is a high quality, and we are making good margin on it. So the ability to further enhance the margin still, it's a separate vertical within our organization. There are some operating costs. So as we build up more and more volumes, the operating structure, operating cost structure will come down, and the success of the overall business will start seeing through. It's not only this, had we just focused on, sanitaryware or the faucet business, the arena within which we are operating, it would be very, very restricted. And especially if you see bathware segment, it gets a full level of a competition even from the unorganized market. So almost 30-40% of the market on bathware segment, let it be faucet, let it be sanitaryware, is both, getting a competition within the organized and even from on the lower end from the unorganized players. But pipes is one such business wherein it's very post-box, core on the manufacturing, you can't outsource the product. And the person who is buying the product is buying basis the quality and also the brand, both of it. So that gives us an added advantage, and it also gives an added advantage that we are now addressing a bigger market. Pipes is a much bigger market than other products. So it gives us a leeway for a continual sequential growth year on year.
Sure. And sir, last time we had discussed a bit about, in your last con call, about shipping. You import a lot of these faucets from Turkey, I believe. So you were talking of shipping part of the production to India. So how is that going? I mean,
I think your question is shifting the imported sanitaryware into our factories. The voice is not that. That's why I'm repeating.
Yes, sir.
Yeah. So I think 2 quarters ago we talked about our initiative around reducing our dependence on imports. I'm happy to share that we are progressing very well on that. In fact, we're developing most of our models in-house right now, and our import contribution, our sales, which is 17%, has come down to now single-digit percentages. And we are also seeing, we're already seeing great improvement in our margins. A part of that is, of course, contributed by the fact that domestic procurement is actually doing pretty well. So, yes, to answer your question, yes, it's progressing very, very well.
And sir, broadly, could we expect the current year top line to beat last year? I mean, overall, because half year has been muted.
So generally, you see, like any organization to talk to, they run a strategy, they run a plan. We are very confident. We have given a guidance that we'll outgrow the market ranging 1.25 times to 1.5 times, and we're still holding on to that in a medium term range. But definitely there are some headwinds in some quarters for the industry, for the company. So we generally don't give any guidances on the forthcoming quarters as a matter of prudence in that perspective. But our plan to grow and our plan to capture the market in terms of the guidance already given still holds.
Thank you, sir. Best wishes for the balance of the year. Thank you.
Thank you. Next question is from the line of Jayesh Gegul, an individual investor. Please go ahead.
Hello, am I audible?
Yes, you are. Please go ahead.
Hello, sir. Congrats for debt number. I just want to know what is the net debt right now, and is there any debt restructuring plan in the future?
So we are looking at a consolidated debt.
Yes, sir.
Consolidated debt on the balance sheet today is around 835 crores, and which has increased slightly over the March figures because of the low trend in sales. Some inventory accumulation has happened, which we feel that should get liquidated in H2. The capex, which is relating to Roorkee, has, the part of that work has started. And also we are investing extensively in terms of our distribution reach to the market, in terms of opening our display centers. So we are investing, in terms to capture the future growth. So, but definitely, we have given a guidance for a debt reduction over a period of time, and as the profit earns through, so we'll reduce the debt.
So my next question is little bit regarding the company's demerger. Actually, we did a demerger in 2019. Our AGI Green Plant and Somani Hindware. That time the valuation of AGI impact was a little bit lesser than allowed Hindware. So I want to, as an investor, I want to that AGI impact give a multiple return to their shareholders. And it was not in the case of Soman Hindware. Now it is a Hindware combination. So do you think that demerger was not in the favor of Hindware and more in the favor of AGI impact?
When this demerger is now almost 5 years old, and there was no favor given to anybody. One shareholder of HSIL got one share of SHIL, so it's technically a sort of a bonus for everybody. So many investors, they were not bullish on that particular company. They might have sold, but today the cycle reversal has happened. In fact, both the companies are performing very well. Only answer which I can give you is on a combined thing. Let's say immediately before the stock got split, the stock was at 220 rupees. But today, if you see combined stock of both the companies together, so it is above 1,200, above 1,500, 1,400, 1,500 rupees. So if anybody would have stuck with us from a pre-demerger basis, he would have made 7 times in last 4 years. So there is a substantial value creation. It's not that, demerger is good for one and not good for other. There was a rationality to a demerger because each of the businesses had a growth plan. And the equities are long-term in nature. So whosoever stuck with us for a long term made a return on it.
Okay. But any further, there is any further chance of demerger because we are now have 4 business like pipe, retail, and hardware. Is there any chances of another demerger?
No, demergers are not done because there are businesses. Demergers are done on some rationality. So nothing as such even in the thoughts.
Thank you, sir.
Thank you. Next question is from the line of Nikhil Gada from Abacus AMC. Please go ahead.
Hi, sir. Thanks for the opportunity and congrats on a.
Nikhil, you have to be louder. I'm not able to hear you clearly.
Is this?
Yeah, not okay. Not okay.
Yeah. So, sir, the first question, is on the sanitaryware and faucets business. We have seen a muted sort of performance in first half. Do you think that second half would be any better, or you still feel that this sort of trend will continue?
Yes. So I think we have seen at an overall level in Q1 the markets to be muted, especially also on the affordable and mid segment. And if you go geography-wise in the tier 2, tier 3 markets, we've seen a bit of a slowdown. There can be multiple reasons for it, of course. Higher interest rate inflation is one of the key reasons, is what we believe. So expectation, of course, is that the second half is going to be much better. That's what we expect. No doubt about that. I think that was something which we were pretty sure that H1 is going to be a little tough and H2 is going to be a much better part of the year, and that's exactly how I think it's going to pan out. This is what our view is. Very difficult for me to give any numbers here, but as an organization we do not give any guidance. But to answer your question, I expect the second half of the year to be much better. We have generally seen, when the market is slow, even you see the COVID times, when the markets are slow, the recovery post a particular event becomes very, very fast. Mm-hmm. Because there is a subset of activity in the market, even if that activity slow down. Once the revival of demand happens, then the whole thing moves very fast. Yeah, and also so this is the thing around revenue, but of course on a profitability side we've done well. We've been able to really deliver set of numbers in terms of growth in our margins. So we've given multiple guidances, not just around revenue, but also around the way we'll be running our business in terms of improving profitability. I think I'm sure you see these numbers even in such difficult situations. Our H1 margins have improved significantly.
Yes, sir. So the next question was on the margin front. You mentioned that the import share has come down to now single digit. So I'm just assuming from that perspective, have we been able to capture most of the benefits of the mix shift in margins, or do you think that this will further improve in the coming quarters?
No, so this is not complete. This is in my view, this is just the beginning of the improvement. And in fact, it will go over a period of next 2 to 4 quarters. In fact, we will start seeing this. So this was one of the biggest initiatives. There are a lot of other things also we are doing. So margin improvement is something which is a high focus for us, and 100% localization has not yet happened. It is something which is still going on. We will see these benefits as we go forward.
Understood, sir. And just regarding that same point, we were of the understanding that once the import comes down, we will see an improvement in the working capital cycle in sanitary ware and faucets. Maybe it's a timing thing, I don't know, but we were also talking about bringing this down to below 100 days. When we acquired the plant from AGI, so it's been almost close to now 18 months, but we're still seeing this working capital cycle in the range of 120 days. So just any comments on that, please?
Yeah. So first of all, on the margin side, we expect our margins to improve nearly 200 basis points over the next 1 or 2 years. So 1 year, you can say, about 2 to 4 quarters.
Understood.
So that's one point I want to mention. Secondly, on the working capital side, working capital is for the constant thing, right? So we did not see sales as much as we thought we would. So there was a bit of an unsold inventory, which is actually in Q1, Q2 we've seen. So if I break down my working capital, we see an improvement on our inventory side by nearly 8 to 10 days, while we have actually seen a bit of an increase in our receivables, which is actually netting off, and you see a bit of a very minor reduction of 2 days in the sanitary ware faucet side of the business. So there is a bit of seasonality in this indirect exercise. When I'm actually reducing my dependence on international markets, I can't go and tell my my importers, the exporters, the people who I'm buying from China, that I'm going to reduce your business. So I maintain a bit of inventory. I manage that by managing my inventory in a certain way, because there's a certain bit of planning I have to do for localizing those same products in India. So because of this kind of a reason, we've not seen significant improvement, but we've seen about 8 to 10 days improvement on inventory side. I personally believe by the end of the year, you'll see these numbers coming down much lower than what you thought they're currently there. And then an exercise on this is going on extensively. Inventory has come down, it'll keep coming down, and at overall working capital level also you'll see a huge improvement.
So, what according to you would be the best working capital cycle in sanitary ware and faucets, or what would be your target? Would it be 80 days, 85 days, 90 days?
So I would definitely love to have something which is closer to, why not lesser, in fact? I mean, why 80, 85 days?
Because actually industry standard is what we are made to believe. So this from that perspective.
Yeah. So I totally agree with you. I think our numbers should be closer to 85, 90 days in the first stage, and even going lower than that in the second stage of our reduction on the working capital. And I can assure you that it's something which is on the cards. It's not too far away when we see these numbers. It's just when a market which has been growing at 16, 17, 18%, we've grown last 2 years at upwards of 40%, 30%, and suddenly you see a 2 quarters and the growth comes down to single digit. Your inventories come under pressure. But as you recalibrate your demand cycle, you recalibrate your existing inventory, these numbers then again start coming back to normalcy. And we have to remember that we are coming from except for the last 2 quarters, if you go back, the previous 8-10 quarters, we've seen growth of upwards of 35-40%. Suddenly, when the growth comes down, there is a bit of a lag effect on inventory side, and that's something which is going on right now. So there's nothing we need to be alarmed about. It's something which is basically a part of the part of the reduction which will happen. I mean, there's a technical term in supply chain called bullwhip effect, and that's something which is happening right now.
Got it, sir. Sir, next is on the plastic pipes business. One of the participants did ask about, running short of capacity. And you mentioned that we have, space in Hyderabad, and we plan to enhance. Is there anything as of now on the anvil in terms of what kind of capacity expansion we are planning and what kind of capex do we allocate to that, and by when can this capacity be on board? Hello.
Yeah, Rajesh. Rajesh, you are there?
Yeah. Nikhil, am I audible?
Yes, sir.
Yeah, Nikhil, see, we have already ordered the machine, and I think from December onwards, we will be adding up the capacity in our existing plant.
Okay.
So, since these machines take a lot of time, and we have added 5,000 metric tons in the past, and we will be adding up similar 5 to 7,000 metric tons in the next quarter. So that will give us a leverage to go to the market and then supply also.
So if I got you correctly, you are saying this 48,000 of annual capacity will go to 54,000.
So presently we have already added up. So we are at 52. We were 47,000. We are at 52,000 now.
Okay.
And we'll be adding up 5 to 7,000 more.
So that basically will go to around 58,000, you're saying?
Yeah.
And the capex for this was how much, sir?
So almost around we have done till for this around 19.9 crores.
Understood. And after this expansion, are we maxed out at Hyderabad, or we can further add in Hyderabad?
No. We can further add up. We are planning in the last quarter also.
Understood.
Because we had already created a second plant, if you remember last time.
Yes.
So we have the capacity. Yes.
So, okay, fair enough. And Roorkee would definitely come in 3Q FY25.
Absolutely.
Understood. Fair enough. So just then one last question, if I may. In the overall balance sheet, if we see, but there has been a capex of close to 70 crores, and I get this 20 crores I think is for pipes. Can you help me understand what is the remaining 50 crores for?
You're talking about pipes?
No, sir, overall on a company level. When I see the cash flow statement, sorry, so we see the capex of 70 crores.
So maybe the question is on the capex.
Yes.
So there is incremental figure of around 15 crores on the development of various, what do you call that, retail spaces, which is this is for Hindware, this is total. And not only for getting another 1.5 for tiles also. So overall 20 crores we have invested into development of our retail center. So this is one.
Okay.
There is a additional spend in sanitary ware plants because we are changing those capabilities to make bigger pieces. Mm-hmm. So another 14-15 crores has been spent in.
So that would be 35 and 20 would be for pipes. So that is 55, and the remaining 50 would be, sir, for.
Where are you seeing the 100 within the overall cash flows?
Sir, I'm saying the first half cash flow statement. And that I've seen the purchase of properties, which is around 70 crore.
We've given you breakup of how much? We've given you breakup of pipes.
So I assume pipes
is around 28. Pipe is 6 is at Roorkee and 22 is at Isnapur.
Okay. Fair enough, yeah. Thank you so much, yeah. Thanks.
Thank you. Next question is from the line of Darshil from Crown Capital. Please proceed.
Hello. Good evening, sir. Thank you so much for taking the question. I hope I'm audible.
Yeah, please.
Yeah. So most of my questions have been answered. So just wanted to get on our consumer business. How are we faring in that, and when can we expect to maybe break even in that? Because it is dragging our profits by some, because around the 12 crore, that's half of what our PBT is. So just wanted to get a sense in that. What is our plan in our consumer appliance business?
On the consumer business, we, as you know, we started with a large portfolio. But I think what makes sense, and we realized over a time, is that some focus on the entire operation will, have a better or lead to better outcome. So not only because of better allocation of resources, but also what we have seen right now in this quarter, that there has been a substantial reduction in inventory when we started on just 2 or 3 main drivers. As already shared, we reduced our working capital by about 44 crore quarter-on-quarter basis, which is a result because we started diverting resources only to the 3 main drivers, where we feel that we have a good right to win. The first one being the kitchen business, where our margins are also good, and we expect that going forward we will have good growth there. The product category, the response of the consumers as well as the trade is it's a very good nature as far as this business is concerned. The second one, of course, water heaters, because we have our own manufacturing, and that has resulted in substantial improvement in the quality of the product. We stand today amongst the leaders, so we are a late starter into this business. But as far as the quality of the product is concerned, much ahead of many of our peers. And then the third one, which is cooler business, which has a seasonality angle to it, which has been visible in the last 2-3 years. But our share on online business is much higher as compared to our overall share in the market. We have disproportionately high share as far as the online business is concerned for coolers. We want to focus on these 3, and we are hopeful that the coming quarter we see in much better of the operations as well as overall business front as well.
So, will it be fair to assume that maybe in FY25 we'll be able to break even on PBT level, sir? Will that be a fair assumption?
Would not want to give a forward-looking forecast on that or projection on that, but let us see how things fare out. If the consumer demand, which we've seen, all of us have seen, has been muted in the last 2-3 quarters. As we see that improving, the current bump or the spike that we see is the uptick because of the festival season. If this is sustained and we have a good summer, then definitely there are much higher chances of getting there. But would like to see as it goes.
Okay, fair enough, sir. And so just wanted to know, sir, that no, actually, sorry, I was just completing all the question. Thank you so much for the answer. All the best, sir.
Thank you. Next question is from the line of Mr. Udit Gajiwala from Yes Securities. Please proceed, sir.
Yeah. Hi, sir. So firstly, sir, we had last time mentioned that we'll be looking to repay 100 crore debts annually. So just wanted to check the progress. Are we still maintaining that, or there are some alterations?
Basically, when we say that 100 crore debt repayment was there, that was in a contextual sense that if we don't invest additionally into the additional facilities, obviously the profit which we are going to earn will go towards the reduction of the same. But as you see, we are investing into pipes because there is a demand, and the debt or the internal growth, instead of going towards the debt reduction, is getting deployed there. So that we are keeping it future ready, in terms of there is a demand. Yes, but I think the debt reduction plan is still there on 100 crores, but it may take another 6 months or so.
Understood, sir. And so what will be the total capex for 24 and 25?
So 24 already spent on 66-70 crores today, And the major chunk which has to be spent is on the Roorkee pipe plant, wherein the total capex is 152 crores, of which just 6 crores has been spent. So I think in next 18 months or so, we should be doing this, the balance, which is all 140 crores and 145 crores. And apart from this, we'll continue our initiatives in terms of development of our, opening of the retail, because that's our plan and strategy. So we'll invest, 15 to 20 crores more there in terms of, this I'm talking about 12 to 18 months next. And some capex on the IT side, because we're keeping organization IT ready, so we keep investing another 2 to 3 crores on the IT readiness, which is here in terms of going digital. These are the broad heads of capex, and some capex on the sanitary ware, as I told you, would be there in terms of the changes which we are doing. So another debottlenecking capex of around 10 to 15 crores.
That's helpful, sir. Thank you.
Thank you. Next question is from the line of Manish Beria, an individual investor. Please proceed.
Yeah, so hi there. So I have seen like Hindware doing a lot of advertisement in this World Cup and things like that. So just want to see what is the advertisement budget this quarter versus last year, let's say, just to get an example, like how much is exceptional advertising cost or budget this year.
Yeah. So you want exact number?
Broadly, I mean something to just to make out like what will be the normalized margin or something like that. If the advertisement doesn't come back to normal fees, let's say.
Yeah. So I mean, for the year we spent about 4%, and it's basically phased across the year. And we saw some opportunity because of the Cricket World Cup. We spent a little extra in Q2, but for the year, that's all.
So basically, the Q2 was higher versus last year, right? I mean, significantly higher.
Marginally higher.
Marginally higher. Okay. The second question could be in the bathware. I mean, we are already doing 16% EBITDA margin, and I think like there are a lot of operational things that you are doing that will expand for import substitution and things like that. So the aspiration could be like 20% margin at some point in time.
So I just mentioned sometime back that we're looking at increasing about 200 basis points over the 2 years. You should actually keep with you. So 20% is not something which we mentioned. We mentioned very clearly around 200 basis points. Say anywhere between 18 to 18.5%.
Okay, that will be all. Thanks.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you everybody for joining us on the call today. We understand the markets are facing some headwinds, but I think this gives us an opportunity to relook internally and build more efficiencies into the system in order to be cost competitive. Be rest assured, I think we are working on the best strategy to put best foot forward in terms of keeping the momentum of growth as well as earnings on the go. Thank you very much. Thanks again. Thank you.
Thank you. On behalf of Yes Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your